And for the latest on what's impacting Wall Street, I do want to bring in the chairman of Great Hill Capital LLC, Thomas Hayes. Hi, Thomas. Thanks so much for joining us today.
Thanks for having me, Greta.
Markets, of course, falling again today as the oil market is facing plunging demand due to lockdowns, keeping people home around the world. Why does the volatility in the oil market impact Wall Street like this?
Well, I think it's two things, Greta. Even though the energy sector is less than 3% weighting in the S&P 500, it's about 15% weighting in the high-yield credit market. So when oil prices fall this low, the markets become concerned that there will be major defaults in the oil patch, and then the knock-on effects with the banks and the daisy chain effects going on with the oil industry to the banking industry to the general economy. And when you have that type of situation, you could see credit markets freeze up and impair their ability to lend to other businesses. I think what you saw in the last 24 hours, though, Greta, is more like a reverse short squeeze. Okay, so in a short squeeze, people who are short a stock are afraid that they can't buy it back, and that's when you see these huge rip-roaring rallies off the bottom. Here, you had speculators that were long oil, and they were unable to find to take delivery because the storage in Cushing, Oklahoma, which is not representative of the globe, but in this unique area is getting close to capacity. So, you know, when you look out down even to the September contract is over $25 a barrel. You look at a year out, it's over 30 a barrel. So I think this short-term dislocation will solve itself.
Another thing, of course, that investors are focusing on is earnings season. First quarter results still coming in now after starting last week. Investors getting a look now at the early economic impact of the coronavirus outbreak here in the U.S. What are you looking for specifically in these first quarter earnings, and how should investors be interpreting these results?
Yeah, well, the consensus on the street, Greta, is that 2020 earnings are going to be down about 12% for the year. That's the bad news year on year from 2019. But when you look forward to 2020, they still have S&P earnings at $173, which implies that as we reopen the country, as we get more antiviral treatments, as people go to work, the demand is going to come back. And when you look at the amount of stimulus that's been put into the economy, once we slowly start getting people back to work, you're going to see that growth come back the second half of the year and certainly the first half of 2021 for sure. So looking at where we are today, the market is a discounting mechanism. Just as it crashed 35% anticipating the bad news that economically that we're seeing today, it's going to start to discount the recovery as people go back to work and in coming months as we get through this.
The last time we saw an economic downturn of this magnitude was, of course, 2008. Many, though, saying this is even worse. You mentioned the stimulus. How has the government response been different this time around?
Well, in terms of that's a great question. In terms of the speed and the magnitude, Greta, it's absolutely night and day. So in 2008, the government and policymakers, they saw the plate falling off the table, and rather than cushion the blow, they let the plate break into 1,000 pieces, and then they spent the next 3, 4, 5 years trying to piece it back together. Here, they learned from the great financial crisis, and they've been very, very proactive. So they see the economic plate falling off the table. They've put the biggest trampoline of all time underneath so it can bounce off softly and slowly be replaced on that table. And what does that mean? It means that the most dire scenarios are expecting GDP to contract about $2.5 trillion maximum for 2020, but they've put in over now, as of today, with the $488 billion package, which I'm sure you're going to talk about, is about $8.5 trillion of direct aid and stimulus, of the Main Street Lending Program facility expansion of $4 trillion, the other $488 billion, and I'm sure by the end of the year we'll get the cherry on top of the sundae with $1 trillion to $2 trillion of infrastructure package. So the minute that demand comes back, if any of your viewers race cars, it's basically like having nitrous oxide in the tank. But until we turn that ignition on, and we haven't, done that, getting people back to work, you can't benefit from the nitrous oxide. But the nitrous oxide's in the tank, and the minute that the demand comes back, you're going to see growth like you've never seen before. It's just going to take a little while to kick in. And if you look at what's happening in China, we're about 2 months behind them, and we're seeing their demand in oil go up, their demand for domestic air travel go up, their rush hour traffic on the GPS is now at pre-pandemic levels, and we're going to get there too for sure.
All right, Thomas Hayes, the chairman of Great Hill Capital LLC, joining us to talk about Wall Street amid the coronavirus outbreak. Thanks so much for coming on the show today.
Want to see more videos like this? Click on the link below and subscribe to One America News on YouTube, and call your cable provider and kindly demand that One America News is added to your lineup. Call and subscribe today.